Welcome to Iron Financial. This is the only place where we forge a stronger portfolio by cutting through all the market weakness. Today, we are putting EchoStar, that's ticker SATS, directly under the forge. Their latest earnings report, well, it didn't just drop a bomb on the market, it dropped a full-on anvil. We're talking about a full-year net loss of $14.5 billion. Now, let's just put that into perspective for a second. A loss that massive could let you go out and buy a company like Snap Inc. outright, and you'd still have billions left over. A number like that should send a stock straight into a crater. But here's the thing. EchoStar, it barely moved. And that paradox, that complete disconnect from reality, is exactly what we are here to deconstruct today. We don't read headlines here. We stress test the structural integrity of the entire company. So the question is this a controlled demolition to make way for a much stronger rebuild, or is the entire foundation about to just crumble into dust?
Okay, so let's really dive into this because this is the central question we have to answer, and it is staring us right in the face. How does a company report a loss that literally vaporizes its own market cap and Wall Street just shrugs? I mean, this isn't some simple beat or miss on earnings. No, this is a puzzle. And it's exactly the kind of puzzle that, if you can solve it, could mean the difference between a huge win and an absolutely devastating loss in your own portfolio. The headline number is screaming at the top of its lungs, "Sell! Get out!" But the stock price? Well, it's telling a completely different story. So the market either sees some brilliant 4D chess strategic pivot that the rest of us are missing, or it is completely asleep at the wheel, just ignoring a fatal flaw right under its nose. Our job, right now, is to figure out which one it is.
All right, hold on. Before we start throwing around words like brilliant pivots and grand blueprints, let's just look at the raw data right here on the screen. Because this is where the confusion starts, and honestly, this smells really fishy to me. Over on one side, you've got an earnings per share loss of $4.19. The so-called experts, the analysts on Wall Street, they were bracing for a loss of maybe 75 cents. This isn't just a miss. This is a public faceplant on an epic scale. But then, you just glance over to the other side of the ledger. Revenue of $3.8 billion, which actually beat their targets. So, which is it? Are they a catastrophic failure, or are they somehow overachievers? You know, whenever I see numbers telling two completely opposite stories like this, my gut tells me someone is trying to hide something in the fine print. So I have to ask, is this real financial performance we're looking at, or is this just some clever accounting magic trick?
That is exactly the right question to be asking. And the answer is, it's kind of neither. To really get your head around this, you have to stop thinking about this report as a normal earnings report. I want you to imagine a skyscraper, right? Before you can build a new, modern, stronger tower, you have to bring in the wrecking ball. You have to clear out the old, outdated, crumbling structure. And that is precisely what EchoStar is doing with its financials. It is a loud, it is a messy, and on paper, it is an incredibly expensive demolition. And yeah, it throws off these completely contradictory headlines that confuse the heck out of the market. But listen, no one demolishes a building without a blueprint for what they're going to build next. So let's start by identifying exactly what it is they just leveled.
This number, right here. This is the smoking gun. Negative $17.63 billion. This is the entire story behind that shocking, headline-grabbing earnings miss we just saw. It's a non-cash charge. It's an accounting maneuver that explains pretty much the entire loss. Think of it like this. Let's say you own a classic car, and you thought it was worth, $50,000. But you go to sell it, and the market now says it's only worth $5,000. Well, you have to write down its value on paper. Now, have you actually lost any cash from your wallet? No. But your personal balance sheet just took a massive hit. That is essentially what EchoStar did here, just on a scale that is almost impossible to comprehend. So remember, this isn't an operational loss. It is a very deliberate accounting action.
And this right here, this defines the weapon they used to do it, a non-cash asset impairment. So in plain English, what does that mean? This is EchoStar management officially publicly admitting that their entire old strategy, this grand plan of building a nationwide 5G network, completely from scratch to compete with giants like Verizon and AT&T, is dead. It is dead and buried. The brutal reality is they were trying to win a game that was rigged against them from the very start. They just did not have the capital, the billions and billions of dollars, to go head-to-head with those titans. So that multi-billion-dollar plan, which was sitting on their books as an asset, has now been written off. It's gone. So while the number is absolutely breathtaking, it's about a past failure, not a current crisis. They're not just clearing the construction site, they're laying the foundation for something much bigger, and hopefully for them, a whole lot smarter.
Exactly. After every single demolition comes the new blueprint.
And now that all the rubble of that old, failed 5G strategy has been hauled away, management has laid out a very clear, very actionable plan for what they're building in its place. This, right here, this is the bull case for EchoStar. And let me be clear, this isn't some pie-in-the-sky dream they cooked up. This is a concrete, three-step plan that they have already started to execute. It's designed to pivot the entire company from a cash-burning builder into a lean and strategic operator. So let's take a closer look at the blueprint for the new EchoStar. Here it is. It's straightforward. Step 1 is all about immediate survival. Get cash in the door and get it in fast. They are finalizing the sale of extremely valuable spectrum assets, and they're expecting that money to hit the bank in the first half of 2026. That is the capital for the entire rebuild. Step 2, fortify the core. You have to stop the operational bleeding and drive their existing wireless business to the cusp of standalone profitability. Make it stand on its own 2 feet. And then step 3, this is the real game changer. Build a brand new pillar for growth. And for this final act, they're bringing in the big guns. They're not building it alone this time. They are partnering with a company that is literally redefining what is possible, SpaceX.
And look, don't just take my word for how important this partnership is. Take a look at this quote from the chairman, Charlie Ergen. Now, this is not some rookie CEO trying to hype up a new deal. This is a man who has been in the telecom trenches for 45 years. He's a legend, he's a maverick, and believe me, he has seen it all. So when he comes out and says SpaceX is the best company he has ever worked with, you listen. He is betting the company's entire future not on his own ability to go out and build another network, the very same plan they just wrote off as a multi-billion-dollar failure, but on a partnership. They are outsourcing the heavy, expensive, capital-intensive lifting to the undisputed best in the business.
Okay, that is a great sales pitch. I'll give you that. A new blueprint, a legendary chairman, a rock star partner, and SpaceX. It sounds fantastic. But a beautiful blueprint is completely worthless if the ground you are building on is about to collapse into a sinkhole. So before we start naming buildings after Charlie Ergen, we need to stress test the existing structure. What is the actual state of EchoStar's business today? Because from where I'm sitting, I see some deep, really deep structural cracks in this foundation. It's time to look at the numbers that aren't some non-cash accounting adjustment. Let's talk about the real cash numbers. Let's start right here. Negative $583.4 million. That is their free cash flow in just the fourth quarter. Let me be really clear. This is not an accounting trick. This is hard currency. This is cash that flowed out the door and is never, ever coming back. To put that into perspective for you, they burned through enough cash in just 3 months to fund the entire annual budget of a city like Pittsburgh. This isn't just a fire. It's a raging inferno in their treasury that is threatening to burn the entire company right down to the ground. You cannot talk about rebuilding when you're hemorrhaging the very cash you need to survive today. And that inferno, it is getting hotter. Just look at this chart. This tells a brutal, brutal story. For 5 years, this company was a growth engine. It was averaging over 50% annual growth. Just incredible. But look at what's happened since. The growth hasn't just slowed down, it has violently reversed. You're looking at a 2-year average decline of over 6%, and they are still shrinking today. The harsh reality is their legacy businesses are being disrupted into oblivion, and they are struggling just to keep up. This isn't just a shrinking business, my friends. This is a business that looks like it's in a death spiral. You can't build a new future when your present is actively decaying right before your eyes. So where is that revenue that they beat on supposed to come from? Well, this is the engine of the company. 7.5 million wireless customers, another 7 million in the old legacy pay TV business, and a handful of broadband subscribers. These are the people who pay the bills. But right now, that engine is sputtering, and it sounds like it's on the verge of stalling out completely. On the surface, sure, the numbers look big, but the only thing that matters in a business like this is the direction of travel. So are these numbers growing, or are they shrinking? And this slide tells that story in cold, hard numbers. This isn't a leak in the boat. This is a gaping wound in the hull, and it is bleeding customers at an absolutely alarming rate. In just 1 quarter, 168,000 pay TV customers fled for the exits. 44,000 broadband customers canceled their service. And even in wireless, the supposed future of this company, they still lost another 9,000 customers. Every single part of their business is losing the very people who were supposed to be funding this grand turnaround. So I'll ask my question again. Is this a brilliant rebuild, or is this all just hype? Because a plan that's built on a shrinking customer base, well, that feels a lot less like a solid blueprint and a whole lot more like a house of cards. You're absolutely right to be concerned about the operational decay. The cash burn is a 5-alarm fire, and the subscriber bleed is a very serious wound. You simply cannot ignore those cracks, but there's an even bigger threat looming on the horizon, one that could make all of these other problems seem totally insignificant. Both the bull case blueprint and the bear case of these operational cracks, they're both overshadowed by a single massive threat. We're talking about a financial wrecking ball, and it is hanging directly over this entire project: the company's staggering, overwhelming debt load.
Just take a second and absorb that number. Almost $26 billion in debt. That's not a crack in the foundation. That is a sinkhole that's about to swallow the whole company. $26 billion is an almost unimaginable weight for a company with negative cash flow and shrinking business lines to have to carry. This isn't just another risk factor on a spreadsheet. This is a full-blown existential threat. It is the clock ticking loudly on their entire turnaround plan.
And it is so critical to understand this isn't one simple loan. As you can see right here, this is a fortress of debt that they have to somehow break through. We're talking billions due in 2026, billions more after that, and just look at those interest rates, almost 12% on some of these notes. That is absolutely brutal in this environment. This is not a single storm cloud on the horizon. This is a series of Category 5 hurricanes all stacked up, and they are scheduled to make landfall year after year after year. Forget about profitability. Their only job right now is to somehow survive this onslaught.
And if you don't believe me, you don't have to, because the company's own auditors are screaming a warning. This term, going concern, is pulled directly from their official filing with the SEC. And let me be perfectly clear, this is not a term you ever want to see associated with a company you own. This is the financial equivalent of a doctor telling you that you have a terminal illness. What it means is that the auditors have substantial doubt that EchoStar can even survive for another year unless it successfully sells those spectrum assets. It is a direct warning to the market. If the blueprint fails, if that cash injection is delayed for any reason, the company may simply cease to exist. This is the ultimate bear case. That going concern language is the heaviest weight possible. There is absolutely no question about it. It puts a hard, non-negotiable deadline on their survival. But this is exactly where we have to pivot back to the new blueprint. And specifically, we have to talk about the SpaceX partnership. Because this deal, it isn't just another growth plan on a PowerPoint slide. It is their potential lifeline. This is the Hail Mary pass that could save them from certain doom. It's the wild card that changes the entire structure of the company, because it directly addresses the very problem that created this mess in the first place. And this slide right here perfectly illustrates the strategic shift. The SpaceX partnership represents a complete 180-degree turn for the company. The reason they racked up $26 billion in debt was because of the impossible task of building a national 5G network from scratch. That strategy failed. They've admitted it. They've written it off. Now they are no longer a capital-intensive builder that's burning billions of dollars on towers and fiber optics. They are becoming a strategic partner, leveraging the state-of-the-art infrastructure that SpaceX has already built and perfected. This dramatically, and I mean dramatically, reduces their future capital needs, which is absolutely critical for a company that is fighting a debt load of this magnitude.
So it's time for the verdict. We've seen the demolition, we have examined the new blueprint, and we have stress-tested that crumbling foundation. Putting it all together, what is EchoStar today? Well, this is not a simple buy or sell recommendation. This is a high-wire act. They are walking a tightrope between a spectacular turnaround story and total, complete oblivion, and one wrong move, one gust of wind could send them plummeting.
Let's just summarize the two opposing structures right here. The bull case, that new blueprint, is compelling. I'll admit it. They're shifting to a leaner, asset-light model. They have incredibly valuable assets to sell for cash. The SpaceX partnership is a potential game-changer, and management swears they are on a path to profitability. But that foundation is crumbling. You simply cannot ignore that $26 billion debt wrecking ball hanging over everything. The cash burn is completely unsustainable. They are bleeding subscribers from every single one of their business lines, and most importantly, their own auditors have issued a going concern warning. That is the ultimate red flag for any investor, period.
So, this is the crucial point, and it's the one question that you must answer for your own portfolio. It is this: can they execute this new blueprint, get the cash in the door, and build a new solid foundation with SpaceX before the old foundation of debt, cash burn, and customer losses gives way entirely? EchoStar is a high-stakes construction project on the tightest of deadlines. The reward, if they succeed, could be enormous, but the risk of total collapse is very, very real. This is one for your watch list, for sure, but be prepared for a wild ride. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.